Venture Global, ticker symbol VG, reported mixed Q2 2026 results this morning. They completely smashed the bottom line consensus, but actually missed on the top line.
Right, a real split decision there.
Yeah, adjusted EPS came in at 51 cents, and that just crushed the 29-cent consensus estimate. Revenue hit $4.58 billion.
Which, is a substantial 48% year-over-year increase, but it still missed the Wall Street estimate of $4.68 billion.
Exactly. And on the forward outlook, management actually raised full-year 2026 consolidated adjusted EBITDA guidance to a range of $8.7 to $9.1 billion.
From that previous 8.2 to 8.5 billion range.
Right. But here's the kicker. Despite the huge EPS beat and the guidance raise, the stock just took a beating. It slid roughly 5 to 6.5% in pre-market trading, dropping down to the 13.30 to 13.50 range.
It's really a textbook example of a bifurcated earnings report. I mean, you have an income statement that looks incredibly robust on the surface, but it's clashing directly with a balance sheet that is giving institutional investors serious pause.
Yeah, so if you are holding this stock in your portfolio right now, you are probably looking at these record earnings and wondering why your position is, bleeding out in the red.
Which is completely understandable.
So as financial analysts, that is the central mystery we are going to solve today. Using their latest earnings call transcripts, their slide decks, and current market data, we're doing a deep dive to figure out how a company essentially doubles its operating income.
And raises its full-year guidance.
Right, and hikes its dividend, only to see retail and institutional investors aggressively hit the sell button.
Yeah, it seems super counterintuitive at first glance, but to understand the market's reaction, we really have to first dissect the actual operations that drove this massive bottom line beat.
Okay, let's get into it. Because the operational numbers are undeniably strong. During the second quarter, Venture Global exported 127 cargoes.
Which means they sold 466.4 trillion British thermal units, or TB2, of liquefied natural gas.
And they hit a pretty massive psychological milestone in the process, didn't they?
Oh, absolutely. They exported their 1,000th overall cargo.
Which is crazy because hitting 1,000 cargoes just 4 years after their very first shipment back in 2022, that is an incredibly aggressive scale-up.
It's a huge logistical achievement, no doubt about it.
But the margins are where my jaw actually dropped. Consolidated adjusted EBITDA hit a record $2.5 billion for the quarter.
Yeah, up 79% year over year.
Income from operations more than doubled, up 111% to $2.19 billion. And net income just skyrocketed.
266%.
Right, to $1.35 billion.
But here is the number that really jumps off the page for me. Their operating margins reached an impressive 47.8%.
Which is, frankly, exceptionally high for this sector.
Well, wait, yeah. A 47.8% operating margin sounds more like a high-flying enterprise software company in Silicon Valley.
Right, not a heavy industrial company. Exactly. How does an industrial energy exporter dealing with sprawling physical infrastructure and ships and pipelines pull off software-like margins? Is this margin expansion coming from Venture Global simply jacking up prices on their cargoes? Or is there a different mechanism at play here?
So if we look at CFO Jack Thayer's notes from the earnings call, the answer is heavily skewed toward volume, not price gouging.
Okay, so it's a volume play.
Yeah, he broke down that $1.5 billion top-line revenue jump quite clearly. Of that increase, $1.3 billion came directly from higher sales volumes.
Wow, okay.
And that volume surge is being driven almost entirely by the ongoing commissioning of their Plaquemines facility. In contrast, only $102 million of the revenue increase actually came from higher net LNG sales prices.
Let me push back on that slightly, though. Just pushing more volume through a pipe doesn't automatically grant you a near 50% operating margin unless, the underlying unit economics are inherently highly profitable.
But that's a very fair point.
So what is insulating them from the usual volatility of natural gas prices?
Well, that comes down to their specific business model, specifically the liquefaction fee.
Right.
Venture Global operates heavily on a tolling model. They are not necessarily taking on the commodity risk of buying the raw natural gas, holding it, and hoping to sell it at a higher price overseas.
Oh, I see.
Instead, they just charge a fee to turn the gas into a liquid state so it can be shipped. And during this quarter, their weighted average liquefaction fee rose to $6.45 per MMBtu.
up from, what was it, $5.58 in the prior year quarter?
Exactly.
So they are essentially operating a highly lucrative toll booth. The gas flows in, they cool it down to negative 260 degrees Fahrenheit, put it on a ship, and just collect a premium fee, regardless of what the underlying gas is trading for on the global market.
Precisely. You nailed it. And when you commission a sprawling new facility like Plaquemines, the initial capital expenditures are just astronomical. But once the facility is built and the gas starts flowing, the marginal cost of producing each additional unit drops significantly. The real driver of that EBITDA beat is the sheer volume of gas they are successfully pushing through this newly commissioned infrastructure. They're capturing those margins of scale.
Okay, so with operations humming efficiently, the gas is flowing, and economies of scale are locked in. Let's look at how management is projecting the future, because their commentary on the earnings call paints a picture of, just blue skies and locked-in cash flow.
They definitely want you to see it that way.
Yeah, they tightened their 2026 expected cargo range to between 500 and 518 cargoes. And crucially, they noted that 91% of their 2026 cargoes are already contracted.
Yeah, that 91% figure, that's supposed to be their ironclad defense against market volatility.
It provides immense revenue visibility, right?
Exactly, for the remainder of the fiscal year. Institutional investors usually love predictability, and having 9 out of every 10 ships already spoken for is about as predictable as it gets in the energy export business.
And they are definitely trying to project confidence by returning some of that cash to shareholders, too. I mean, they declared a quarterly dividend of 4 cents per share, which is a 122% increase.
Yeah, CEO Mike Sable was very vocal about this on the call. He boasted about the company's ability to, quote, successfully build and operate complex machines that generate exceptional results.
So he is framing Venture Global not just as a commodity exporter, but as a top-tier industrial operator.
Right, and he spent a lot of time highlighting the recent debt refinancings, including $2.25 billion in senior secured notes.
And that refinancing effort is a critical piece of management's bull case, isn't it?
Oh, absolutely. Sable noted that these recent maneuvers will translate into over $100 million in annual cost savings.
Wow.
The narrative they are pushing is that they are lowering their cost of capital while simultaneously bringing immense new volume online.
Furthermore, Sale pointed to a significant macro tailwind for the back half of the year. He stated that Europe is, quote, dangerously exposed to severe winter weather, both physically and economically.
Yeah, he is clearly banking on the baseline demand for U.S. LNG remaining highly elevated.
Right. He wants the Mazda to know that the remaining 9% of their uncontracted volume is going to fetch a massive premium if Europe freezes.
He is attempting to set a floor for their uncontracted spot market volumes. Like, if a harsh winter hits, those spot prices will surge, and Venture Global stands to capture pure upside on that remaining capacity.
Okay, but here is where the narrative hits a wall. I need to play devil's advocate for a moment here.
Go for it.
If 91% of the year's revenue is locked in via solid contracts, and they are saving $100 million a year just by restructuring their debt, and the CEO is openly predicting robust European demand this winter.
I know where you're going with this.
Right. Why is Wall Street treating this stock like toxic waste? Why did we see a heavy morning sell-off on what looks, at least on paper, like a total blowout quarter?
Because the market isn't looking at the 91% contracted volume right now. It is staring directly at the debt load and the legal drama.
The debt load.
Yeah. Venture Global is currently carrying a staggering $41.5 billion in long-term net debt.
Okay, $41.5 billion is huge. But in the infrastructure space, debt is just the cost of doing business, right?
Yeah.
I mean, you can't build a multi-billion-dollar export terminal with, like, spare change from the corporate treasury.
Right.
Why is the market suddenly terrified of leverage now?
It is the absolute scale of the leverage relative to their equity. Their total liabilities sit at $49.4 billion.
Oh, wow.
Yeah, this puts their debt-to-equity ratio at over 3.4.
Over 3.4.
Exactly. To put that in context for you, a healthy debt-to-equity ratio in the capital-intensive energy midstream sector typically hovers around, 1.0 to 1.5.
So a ratio of 3.4 means the company is incredibly heavily leveraged.
Incredibly. It leaves almost zero buffer for macroeconomic shocks.
But wait. Didn't management just tout $100 million in annual savings from refinancing their debt? If they were lowering their borrowing costs, shouldn't that alleviate some of this pressure?
You have to separate the interest rate from the principal balance. Despite securing a lower rate on some of their obligations, the company's quarterly net interest expense actually rose.
It rose?
Yeah, it jumped from $310 million in the same quarter last year to $489 million this quarter.
How does interest expense go up by almost $180 million in a single quarter if they just successfully refinanced?
Because the absolute size of the debt pile is growing so rapidly to fund their ongoing expansion projects, specifically the CP2 facility.
See?
The percentage rate they pay on the debt might be slightly better due to the refinancing, but the principal is so large that the absolute dollar amount they pay in interest just continues to balloon. I mean, they are paying nearly $500 million every 3 months just to service their debt.
That completely recontextualizes the $2.5 billion in EBITDA. Suddenly, a massive chunk of that operating income is spoken for before it can ever be reinvested or meaningfully returned to shareholders.
Exactly.
And I imagine this makes any potential delay in their expansion projects highly problematic.
Highly problematic is an understatement. There are growing concerns among analysts right now over potential cost inflation and delays at their CP2 expansion project.
Right.
When a company is leveraged to a 3.4 ratio, they require continuous, uninterrupted access to global credit markets. Any delay in bringing a cash-generating asset online means they have to service that towering debt pile without the new revenue they were projecting.
And the market punishes that kind of delays severely.
Oh, absolutely.
But the risk profile isn't just limited to construction delays, is it? We need to talk about the legal cloud hanging over them right now because it seems to be actively scaring off risk-averse institutional investors.
Yeah, they have an unresolved ongoing arbitration with BP.
Right, the B-play arbitration.
While the specific granular details of the dispute remain somewhat guarded, these types of arbitrations typically revolve around delivery obligations and force majeure claims.
Okay.
And on top of that, there are new shareholder investigations. Firms like Purcell and Lefkowitz LLP are looking into contracting transparency.
Let's break down why contracting transparency matters so much here. Because if management is claiming that 91% of their volume is contracted, why would Wall Street care about a law firm investigating transparency? I mean, contracts are just contracts, right?
Not in this industry. The entire bull thesis for Venture Global rests on the reliability of that tolling model we discussed earlier.
Right, the toll booth.
Yeah. Lenders and institutional equity investors base their risk models on the assumption that those long-term contracts are completely ironclad. If an investigation reveals opacity in how those core revenue contracts are structured,
Like maybe hidden exit clauses for the buyers.
exactly, or unfavorable terms tied to delivery delays, then that 91% contracted figure suddenly becomes incredibly soft.
So if the contracts are perceived as weak, the future cash flow is perceived as weak. And if the future cash flow is weak, a $41.5 billion debt load suddenly looks unserviceable. It is like they just bought a sprawling luxury mega mansion using a highly leveraged variable rate mortgage. Right at the exact moment the foundation is starting to crack and the neighbors are suing over the property lines.
That is a brilliant way to put it.
Because the house itself is gorgeous, right?
Yeah.
That is the record EBITDA and the 47% operating margins. The cash flow looks great on a sunny day, but the financial foundation holding the house up is just sweating under the immense weight of the mortgage and the legal fees.
That visual captures the institutional hesitation perfectly. Investors are demanding a substantial risk premium to hold this stock. A top-line revenue miss under these specific conditions is no longer just a slight operational hiccup.
Right, the market is signaling that there is absolutely zero margin for error.
Zero.
And that zero margin for error brings us to the most glaring red flag in this entire earnings report, which is the insider selling data.
Yeah, this is where it gets really concerning.
Because we looked at the institutional flows, and they paint a very mixed picture. The Healthcare of Ontario Pension Plan, known as HUSHEP, did actually buy 251,000 shares in the first quarter, worth roughly $3.96 million.
Right, and pension funds typically invest with a multi-decade time horizon, so there is clearly some long-term institutional appetite for this infrastructure.
But while the pension funds were buying, the people actually running the company were quietly heading for the exits.
This creates a stark divergence between management's external messaging and their internal behavior.
Right. Over the last 90 days, insiders sold 4.46 million shares worth roughly $58.7 million. And we aren't just talking about low-level executives exercising a few routine stock options here.
Yeah, not at all.
CFO Jack Thayer dumped over $1.5 million in stock. COO Brian Cawthorn sold over $450,000.
When the chief financial officer...
For guy managing the debt.
Exactly. The exact person tasked with managing that $41.5 billion debt load and the chief operating officer are liquidating millions of dollars of equity in the immediate run-up to a highly leveraged expansion phase It speaks volumes.
It completely shatters the narrative. CEO Mike Sable is on the earnings call boasting about exceptional results and European winter tailwinds, but his top lieutenants are literally cashing out.
Yeah, insider dumping in the face of a 3.4 debt-to-equity ratio tells institutional investors that perhaps the risk-reward ratio is fundamentally skewed to the downside, regardless of how strong the current quarter's EBITDA looks.
So, okay, to summarize this whole dynamic for you, Venture Global is currently delivering a masterclass in operational scaling and margin expansion. They're moving staggering volumes of LNG, hitting major export milestones, and generating unprecedented operating income.
The operational success is undeniable. Hitting 1,000 cargoes is a monumental logistical achievement.
But the intricate financial engineering required to sustain this aggressive growth has created a deeply fragile equity profile. For retail investors analyzing this quarter, the reality of a $41.5 billion debt load, a growing legal overhang regarding contract transparency, and a C-suite that is actively selling tens of millions of dollars in stock requires serious caution.
It absolutely forces investors to ask whether the underlying business model is truly sustainable or if it is entirely dependent on perfect macroeconomic conditions holding steady while they attempt to build out the CP2 expansion.
Which leaves you with a final, broader question to consider, one that extends well beyond just the upcoming European winter. Venture Global has built a financial structure that absolutely requires continuous high-volume global exports to service its towering debt.
Right.
But what happens if the macro environment fundamentally shifts at the regulatory level? I mean, think about it. If domestic natural gas prices spike in the United States, there could be immense political pressure in Washington to cap or restrict LNG exports just to keep heating and electricity costs down for American consumers.
That's a very real regulatory risk.
Exactly. So with $41.5 billion in debt and rising quarterly interest expenses, what does a sudden federally mandated cap on export volumes do to a balance sheet that is already this stretched? Is this level of leverage just a calculated risk in building a global energy empire? Or does regulatory exposure make it a ticking time bomb?
It's definitely something you have to weigh before jumping in.
Absolutely. Make sure to follow the show for your daily earnings coverage.